Hello and welcome to CMS Forex News. I'm market analyst Nick Nassad. Today is Tuesday, January 27, 2009. We start with the Aussie Yen pair, as the risk appetite we saw yesterday gave way to further risk aversion today. Stocks were up in Japan, which helped the pair reach a high near 60.28, but European trading saw today's gains pare down to reach a low at 58.16. Stocks in Europe were hurt by lower oil prices, which fell as much as $3.40 by 3 p.m. Eastern Standard Time, which hurt oil producer shares and commodity currencies. The European markets staged a late recovery as New York indexes stayed green for the morning. In fundamental news from the Asia-Pacific region, Japan showed that the index that measures how much companies pay for services fell 2.5% on the year in December and 0.5% on the month. That was close to expectations and shows the decrease in prices that has been a hallmark of the end of 2008. The main decline was in ocean freight as oil prices tumbled in the second half of 2008. In Australia, producer prices for the fourth quarter surprised forecasts as the increase of 1.3% was much higher than expected. On the year, prices are up 6.4%. Increases in the prices for industrial machinery and equipment offset price declines as a result of lower petroleum refining. Aussie business confidence for December rose in December off its all-time low in November. The overall sentiment index climbed 10 points to negative 20, while the business conditions gauge, a measure of hiring, sales, and profits, rose to negative 6 from negative 17. The question now is if this was a temporary bounce or the start of a turning point from the overly pessimist recent readings. Moving on to Germany, the IFO business climate for industry and trade showed a slight improvement for the month of January, increasing to 83. The two components of the business climate changed in different ways. Whereas the firms again assess the current situation as worse, they are a little less skeptical about their business in the next 6 months. In a second release from Germany, import prices fell more than expected, registering a 4% drop on the month and is now down 5.1% compared to a year ago. That annual rate was the highest price decline since November of 2001. The euro-dollar pair reached a high near 1.3330 in the wake of the German releases, but came back down as the mood of risk appetite soured in the European session. The pair found support near 1.3120, so the euro managed to hang on to its impressive gains from yesterday. In the UK, 16% of retailers said year-on-year sales rose in the first half of January, while 63% said they were down. The resulting balance of negative 47% represents another heavy fall in sales, but the decline was slightly slower than in December. The euro-pound pair, as we mentioned yesterday, looked ready for a dip, and it followed through with that today, falling to a new one-week low of 0.9280. The pound was boosted today as investors' concerns eased about the amount of money needed to bail out UK banks. That was a theme started yesterday by the Barclays Bank. The pound-dollar pair rose to 1.4240, breaching resistance at the 1.40 level and extending the gains from yesterday's sharp rally. The pair has now climbed 600 pips from its 23-year low near 1.35. The rally has paired about 50% of the fall we saw in the pound from January 16th to January 23rd. In U.S. news, the S&P Case-Shiller House Price Index continued to show broad-based declines in the prices of existing single-family homes across the U.S. in November. The 20-city index showed an annual record decline of 18.2%, while the 10-city index matched its record decline from last month at negative 19.1%. In two other releases, consumer confidence, as measured by the Conference Board, fell to a new record low in January of 37.7. Consumer attitudes towards both current and future conditions deteriorated. Meanwhile, manufacturing activity in the Atlantic region for January, as measured by the Richmond Fed Index, remained near all-time lows seen in December, though the pace of contraction was slightly slower. The dollar-yen pair was down today after rising in the Asian session. The pair broke below its short-term line of support at the 89 level to fall to 88.40. The triangle pattern we showed yesterday has been breached on the bottom now, which could suggest further yen gains. However, there may be a limit to how much the yen can strengthen, as the Bank of Japan said it may intervene in the markets if the pair falls to the 87 level. The yen's gains came despite U.S. equities trading in the green for today's session. Looking at the upcoming fundamental schedule, tonight Australia will post its leading index and its consumer prices for the fourth quarter. Overnight, Germany releases data on consumer confidence and consumer prices, and Switzerland reveals its leading index. Tomorrow afternoon, the FOMC finishes up its meeting, and all eyes will be on the statement for more clarification on how the Fed will try and ease the problems in credit and financial markets. Also on tap in the afternoon will be the interest rate decision by the New Zealand Central Bank, which is expected to slash rates from 5% to 4%, a 100 basis point reduction. And that wraps up today's broadcast. Thank you for joining us here at CMSFX.com, and happy trading.